and welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Company Limited as part of the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to another episode in our series. Factor investing in mutual funds is about investing in stocks and creating a portfolio based on specific factors. Traditionally, fund managers decide what to include and exclude from a mutual fund portfolio, and that is why there is a significant human element and possible bias in the process. However, factor investing is formula-based, and the constituents of a portfolio are chosen based on factor-based filters. There are factors like momentum, alpha, low volatility, and value, which are becoming popular. Industry players have launched various factor-based funds which track particular indices and aim to mirror their underlying index. So factor investing is a mix of passive and active fund management. Today, our discussion will be around these. What is factor investing? What are these factors? How are they used? And for whom are these useful? To provide insights on this relatively new concept in the Indian market, we have with us Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Mr. Prateek Sinha, who has years of experience of advising investors across asset classes. He has headed Asia business for Edelweiss Alternative Asset Advisors in his previous assignments and currently engaged in his family business. Welcome, Mr. Haria and Mr. Sinha.
Thank you.
Hi, Versha. Thank you.
Let's begin now the session without a delay. So, Mr. Haria, to begin with, please explain how factor investing strategy differs from traditional investing strategies.
Sure. So if you look at it, equities as an asset class is picking up pace, but it's not new to India. I think Bombay Stock Exchange is there since 1875, and pretty much equity investing as a culture has been there. Earlier, people used to invest, before the mutual funds came in, people used to invest directly into shares. Now with mutual funds coming in, there is a professional management of active funds. So typically active funds are what was very popular in India over the last 10, 15 years and is still popular. In the last 6 to 7 years, we are seeing passive funds, which is essentially index funds and ETF, which track underlying indices, which are becoming more and more popular. Also because pension funds are investing in them, they are becoming larger in size. Now, these passive funds, they are mirroring an index. Now, what is this index? This index can be on the basis of market capitalization, which is the more typical, well understood indices, right? The large cap indices, mid cap indices, small cap indices. So based on the market capitalization of the stocks, the top 50 names or the top 150 names in the mid cap are chosen. Now, that was the popular median. As we moved along, there were sectoral and thematic indices also which came in. Banking as a popular index for passive investing also came in. And with knowledge, with understanding, with widening of the investor base, with family offices and RIAs becoming bigger, there was a need on the ground to have even smart beta factor-based indices. And that's where, much like how the West, where when interest rates came down meaningfully, dividend yielding smart beta strategies did very well because higher dividend yield compared to low interest rates became popular. In India, we are seeing low volatility as a strategy picked up, then momentum as a strategy is picking up. So you mentioned the four strategies, typically low volatility at the conservative end, momentum at the aggressive end, and in between you have value and quality also. These are the 4 or 5 strategies within smart beta which are very attractive. Now, what is smart beta? That was your core question. Smart beta is essentially, like you said, picking up a selection of stocks based on a particular rule or methodology, which is taking into account a particular factor, right? So for example, when an active fund manager makes a portfolio, they have a universe, then they will select a certain stocks or certain sectors, create a portfolio of 30, 40 names. Similarly, in a smart beta, the factor is defined. So for example, if momentum is the factor, then over the last 6 months and 12 months, whatever are the stocks which have done well out of the universe of, let's say, the top 200 names, you pick up the 30 stocks which have done the best in terms of performance in 6 and 12 months based on a methodology. You select those 30 names, give them a weightage which is also predefined as per the methodology. So selection of the stocks in the smart beta And the weightage of those stocks in that smart beta, which is rebalanced every 6 months, is what makes the smart beta a portfolio which has an element of passive and active, like you mentioned. And that is why smart beta is becoming more and more popular. In very simple terms, the selection and the weightage of that particular index, which is being mimicked by which is being replicated by the smart beta strategy, is on the basis of factors, and those factors can be fundamental factors, price factors, and in India they are becoming more and more popular. We'll move along in terms of the details as we get along, but this is the broad nature of what a smart beta factor-based index is, and like you said, it is becoming very popular in India.
Thanks for giving the overview of factor investing and smart beta funds. So my next question is from you, Mr. Sinha. How is factor investing implemented in mutual funds? And could you elaborate how it's done?
So see, factors have always been a part of our investment strategies, right? So you would have heard fund managers saying we are focused on quality. Some of the fund managers, we have value as a category, right? So what was fund manager doing? He was taking a filter saying, okay, companies which have an ROE of about 15%, whose price to equity is so and so. If you define certain parameters, then they would shortlist the universe, right? Once the universe was shortlisted, they would apply their discretion to pick the funds, pick the stocks, and give weightages, right? Now, if you're doing it in a systematic manner in a factor-based fund, what you'll do is you'll define the rules, right? As Mr. Chintan mentioned, and then you apply the weightages, and then you pick the portfolio based on certain characteristics. Now, it can be implemented in two ways. If you're talking about the pure factor-based strategies that we're discussing, the more systematic ways, so they can either be done through an active fund or a passive fund. Now, a passive fund will basically replicate an index that is available in the market, which is, let's say, for example, an NSE 200 Momentum 30, or it could be a BSE enhanced value. And every fund manager who launches a fund on a passive strategy will be replicating the index that has been provided for by BSE or NSE, right? Or any other index provider. When it comes to an active strategy, an active mutual fund implementing the same thing, they'll again define the rules and the weightages, but that will be unique to that particular fund manager, right? So if a fund house which launches an active momentum fund will have its own parameters which will define momentum. So again, it will be systematic, mechanized, and formulated, right? But it will be unique to that fund house. So it can be implemented either through an active strategy or a passive strategy, and done through it. Maybe Chintan, you might want to add a little bit about implementation part.
Yeah, so much like how Mr. Prateek mentioned, mutual funds already have quant-based funds which are taking into account factors and forming a portfolio on the active side. So you have, I think, minimum various funds also in the market which are taking call on the active side. In the active side, of course, you have a factor-based selection methodology, and then the fund manager overrides in terms of certain stocks which you may not want to have. While in the case of passive, the defined parameters, once the universe is defined and the parameters are defined in terms of factor, number of stocks, that's exactly what you will get. So in the case of passive investing, you will have a certain level of confidence as to what exactly to expect, and not just that, on a daily basis, the factors, the portfolio based on the factor is disclosed. So you can actually see what are the stocks in the portfolio on a daily basis, because the portfolio deposit is disclosed every day. So you know exactly what is the constituent and where is your money going. That's the advantage of passive investing within the smart beta or otherwise also. And in India, with the growing demand, you have much more options. What Mr. Prateek mentioned, you have now momentum, you have low vol, you have quality, you have value-based smart beta strategies. And as we move along, I'm sure you'll get many more strategies. In fact, we did launch India's first smart beta multi-factor strategy also, which was alpha low vol, which is basically combining low volatility and momentum to form the alpha low vol. So there are a lot more, I'm sure, options which others are also thinking, and as an industry it will grow. But yes, as far as implementation of smart beta strategies is concerned, starting I think 2017, over the last 7 years, we've seen a lot of opportunities both on the index funds and ETF side for investors to explore, understand, and then make part of their portfolio within the mutual fund passive investing bucket. Thank you.
Thank you, Mr. Haria, for clarifying it. And it is really good if there is transparency in factor investing where investors can check the portfolio on a daily basis, which is really good. So my next question is from you again. Mr. Haria, what are the risks associated with factor investing? And how can investors mitigate these risks?
So of course, see, market is wide and different themes, different factors work in different time cycles. So if you look at the long run, if you stick to a particular strategy and invest systematically, of course, it will work for you in terms of value creation, much like it does in terms of market capitalization based ETFs or generally investing in equities. So the longer you invest in a strategy, the better it is. But like most of the things in the market, there are cycles which each factor goes through. For example, if you look at the value strategy, which Mr. Prateek mentioned, value as a strategy works at a time where there's a market shift which happens. There are times in the market where if liquidity is loose and there is a low interest rate, growth-oriented stocks tend to get more premium. So we saw 2013, 14 to 2018, 19, maybe even 20, growth stocks did very well. Then, of course, post-COVID, it is the value stocks after, I think, August 2021 which are doing very well. So value as a strategy would have underperformed between 2017 to 2020 had you had it in your portfolio. But that same strategy between 2021 and 2024 would have done very well for you. So much like all investments within equities, even factor investing can be cyclical and it will have its own cycles. We need to understand those cycles and then form a portfolio. Low volatility is the opposite of that. Low volatility did exceedingly well between 2018 to 2020. And between 2021 and 2024, because cyclical sectors did well, low volatility as a concept, which is meant to be more conservative, stable stocks. Typically, they'll have IT, FMCG, consumer names within their fold. You are finding low volatility did not do as well as the cyclical or the value basket. So these sectors or segments or factors will have their cycles. The discipline of long-term investing, the discipline of keeping on adding on as the market gives you opportunities during corrections will allow you to get the full benefit of factor-based investing as well. And we've basically found that something which is a combination of low vol and momentum, which is alpha low vol, can actually give you an in-between path between these two extremes and allow your portfolio to basically get the full benefit of the top 150 names which are there, at least as far as alpha low vol. So the universe also matters. In the last 3 years or so, we've seen mid and small caps do well. Factor-based investing strategies mostly are focusing on the top 200, top 300 names in general, and hence you may miss out on the mid and small cap names. So this is also one of the risks in factor-based investing. Now, as an addition to that, we are seeing factor-based investing strategies coming even in mid and small cap in the market. So I think as the market kind of evolves, we will find more and more opportunities for you to select from. But as of now, the risk is only if you have a shorter term view and if you get stuck in a cyclical low time as far as any factor is concerned. Otherwise, because of diversification, because of the selection methodology very clear, your risk to a very large extent are minimized when you are investing in factor-based ETF. It is essentially equity product. So obviously equity related risks remain. But as far as diversification, as far as individual risk weightage, individual stock weightage, all of that get mitigated meaningfully because of the structure in which the factor-based ETFs are, constructed. Wherein no single stock generally you will find is more than 5 to 7% of the portfolio, and you have a good mix of 30 stocks across various segments and sectors. So you're not taking any sector risk, you're not taking any stock concentration risk, and hence while there are risk factors, in general, the factor-based investing is becoming more popular because the rewards or the diversification and the advantages which it is providing is far greater than the risks or the disadvantages which they carry. Thank you.
Varsha, just to add to what Mr. Chintan was saying, see, there are two ways to combine factors in a portfolio. One would be, as he mentioned, right, alpha low vol, where you are first filtering the stocks on alpha and then finding the stocks which have the lowest volatility. The other way could be to combine factors individually, like single factors. So I can build a multi-factor portfolio of 4 separate factors, right? For example, if I take quality, value, low vol, and momentum, and allocate 25% to each. Now my portfolio is balanced across all the styles. Typically when momentum is doing well, low vol will suffer, right? But as the market turns and momentum gives you a drawdown, low vol will actually come in and save your portfolio. Similarly, in quality and value typically don't work at the same time. So when quality stocks are doing well, typically that's the time when you'll find value underperforming. The moment you mix quality and value together, the cycles get mitigated to a larger extent, right? The ideal way to do would be to combine all four factors, give them an equal weight, and let this run for a longer period of time. And your returns will actually, you will have a higher return than the market, or you should expect to have a higher return than the market. And historically, what it has shown is the volatility of the portfolio has also come down significantly when you have mixed all four. So the risk-adjusted return was better over the last 20 years backtested data, as well as the pure return itself was also better. They did well during the crisis, like for example, the 2008 crisis or 2020 during the COVID crash. If you had a portfolio made up of all four factors, your portfolio actually survived and did better, and it recovered faster than the market. Again, this is based on backtested data available on the NSE, and nobody can predict how these things will play out in the future. But it makes sense, right? You want to diversify your portfolio. You take stock things which have done well or which have exceeded the benchmark over long periods of time. And second thing you want in the portfolio to be truly diversified is that they should perform at different points in time. So if you have assets which have outperformed the benchmark over, say, a 10-year period or 15-year period, and their outperformance cycles are not together, then your portfolio at any point in time will have styles or factors which are doing well, and therefore over a long run, your portfolio will actually outperform more consistently than let's say NSE 500 or Nifty 500 and Nifty 200. At least the backtested data shows that.
Thank you for explaining this. So in a way, can we say that these are complementary? So one factor is giving the growth to the portfolio while other is mitigating the risk. So yes, what should investors look at while investing in factor investing funds?
When you're looking at investing in factors, there are a couple of things you need to look at, right? First is, as Mr. Chintan mentioned, you should have a very long-term view. See, factor premium or the extra returns that factors have earned, they are based on solid research, and each of these factors have actually won a Nobel Prize, right? But they're all based on long-term basis, right? So if you are, while we have seen factor-based investing doing really well in the last couple of years, as an investor, you need to know that these alpha or the factor premiums that you get are meant to come over a long term. So you do not take a short-term view. And I'm seeing a lot of investors actually trading using momentum or value ETFs, right? Because they were doing so well. So first thing that an investor, you need to make sure that you have a long-term orientation. Second is what you need to look at is your risk profile, because each factor has a different risk profile. A momentum is meant to generate high returns, but that comes at the risk of a bigger drawdown. Whenever there is a market turn, right? Let's say, for example, what we saw in 2020, a big crash, or 2008, that time momentum will suffer, right? So if you have a lower risk profile, you need to select the right factor for yourself. So if you're a risk-averse investor and you want to invest in factor, probably a portfolio tilted towards low vol will actually suit you better as compared to a momentum style, right? So that is one thing. The second thing which I see is when choosing a fund, one needs to analyze the index on which is getting replicated. I'll give you a simple example. If you look at the NSE 100 low vol 30, right, and the BSE low vol index. BSE low vol index picks the low volatility stocks from a portfolio of top 215 companies, right? Whereas the NSE 100 picks it only from top 100. But the volatility and the drawdowns for the BSE low vol were actually lower than NSE 100. And the reason for that was the way the index has been constructed. NSE 100 low vol 30 would replace a stock that has come into its portfolio, the top, if it's in the top 30, only if it, let's say, for example, goes below 60th rank, right? So you're looking at the statistical measure of volatility and saying, okay, you were amongst top 30. Now I can't change every time a stock moves out 30, right? Because that requires a lot of churn. So they have defined that, okay, if it goes outside of 50 or 60th rank, that is when we will change it. Whereas the BSE is a little more stringent. So if it goes out of top 36 or 40th, I don't remember the exact numbers, they'll remove it. So if you're removing a stock, the moment the volatility is increasing, that is coming at the cost of higher churn in the portfolio, but probably it's able to serve you better because your aim eventually is not to have portfolio or stocks in the portfolio which will crash. So looking at how the index has been constructed and then picking the fund is also very, very important. And of course, each of these factors are subject to their own risk, and therefore we need to analyze the risk that we're looking at. For example, if the markets is really richly valued, you feel the market's really overvalued, and there might be a correction. Taking exposure to a momentum factor might not be the best thing. Maybe time to move into low vol. So these are the kind of things you need to look at the market scenario, your own risk appetite, have a long-term view and look how the index has been constructed, and then choosing the fund, especially on the passive side, would actually be some of the things that I would advise investors to look at while building a portfolio using factors.
All right. So choosing the index fund is and looking at the index is also very important. But my next question is from you again, Mr. Sinha. Isn't it too difficult? Because for the layman investors, finding and understanding factor investing is difficult, and then choosing the, you know, finding out the correct index based on which the factor-based funds are created, isn't it too technical for them? How
It
should
is.
they do it? Can they do it themselves, or again, they need to go
I
through?
think eventually, see, the idea factor timing is very, very difficult. So, like, their factors have their cycles, right? So, typically, if the economy is going from a contraction to an expansionary phase, your interest rates are low and rising, right? And the earnings growth is coming in, broad-based earnings growth is coming in. They're typically signs of economy doing well, right? Picking up steam from bottom. And that is the time normally value starts doing well. Then as the markets reach a trending momentum starts to do well, and as the interest rates have risen, corporate EPS growth slows down, handful of companies are doing well, then that's when you'll start seeing quality and low vol started to shine, right? But that is again very different. So therefore, I would advise to someone who wants to do it on at their own end would be to pick up build a diversified portfolio with having all the four factors and do it over a long-term period. That should take care of most of the issues that you as an investor will face, because it takes care of the cyclicity of the factors, because certain factors might be out of fashion. For example, value did not deliver any returns from, let's say, from 2010, 11, 2020, roughly. There was hardly any return. But a well-diversified portfolio having quality, value, momentum, and low vol still managed to outperform the benchmark based on the historical data, right? So having a well-diversified portfolio of having all the factors it's like this. We as investors tend to buy what is in vogue, what is in fashion, right? But and then we say we have portfolios diversified. But अगर आप चार दुकान से चार ब्रांड का बासमती राइस लेके आ जाओगे तो आपके पास बासमती राइस ही है. So if you're picking four funds from four different fund houses, all are operating on the same factor, your portfolio is not truly diversified. If you want a balanced meal, you have to have roti, dal, chawal, sabji, right? And therefore, that is what I meant, right? You have value, quality, momentum, low vol. And that's a balanced meal. And that will take care of most of the issues that you have. And have a long-term view, it's not that difficult to make returns from the market.
All right, wonderfully explained. Then I think that you need to check how nutritious is your plate rather than filling it up with just one dish.
Yes.
Thank you. So my next question is to you, Mr. Haria. What is the trend of adoption of factor investing among retail investors?
Yeah, so I think if we look at in terms of popularity, low vol, which was not very popular until 2020, I think as an industry, the AUM is crossing, I think, more than 5,000 crores. And that is meaningful because if you look at some of the sectoral funds also, they have not been able to pick up after being in the market for even 20 years. They've not been able to cross 2-3,000 crores of AUM. So clearly, in terms of adoption, once people have realized the advantages of going the factor way in terms of having a diversification, we are seeing more and more adoption, especially from the HNIs, especially from the RIAs who are advising the HNIs and family offices. And I think it makes perfect sense for those who already have a active portfolio which is large to diversify themselves into factor-based investing. So in India, the question often comes, should I go active? Should I go passive? Should I go factor-based? The idea is through a good advisor, a good person who can plan your overall portfolio, and we all will need help from a professional for planning the portfolio. To your previous question, can someone do it themselves? Of course, you can do it yourself. You'll have to probably put in 3 to 4 to 5 years of learning, understanding, reading, which you may not have time in your normal day-to-day course of life because you are not necessarily an investment professional. So leave the job of creating an investment portfolio to the professionals, and they will in turn be able to incorporate the right mix of active, passive, factor-based, even probably at times going the thematic way or the sectoral way to add that much bit of alpha in your portfolio. And that is essentially how we believe most of the growth that is coming in today in terms of the factor-based investing is coming from professionals who are hand-holding individuals. There may be individuals who obviously have a lot of knowledge, but it is professionals who understood this in detail and then bringing it as part of the additional complementary portfolio for the larger investors in the market who would be having active, who would be having value, who would be having all the diversified large cap, mid cap, small cap within the active side, and add to that the passive side as well through smart beta factor based or plain vanilla Nifty 100, BSC 500, Nifty 500, whatever the case may be. But the objective is that the growth is there, because from a total market perspective, wherein I think equity mutual funds are about 35 to 40 lakh crores out of the 60 lakh crore, smart beta is still just a very small fraction. I don't think it is more than 20,000 crores, everything put together. So it's a very small segment right now of the overall segment, less than I think 1% of, maybe about 1% of the total equity assets. But the fact is, in absolute terms, it is growing meaningfully. And as the people understand more and they have the right advisors, it will be incorporated in their overall portfolio. And I see no reason why this space, much like how it has grown in the West, will grow in India as well.
All right. Mr. Sinha, how do these different market conditions can impact factor investing strategies? I mean, you have already mentioned, but how does market cycles can impact investing?
See, market cycles have a huge role to play when you're looking at factors, and different factors do well at different points in time, right? So typically, when would you buy value? The idea behind buying value would be the valuations of the overall market are really low. You're looking at an economy which had gone into a recession and is coming out of it. You're looking at a broad-based earnings recovery that shows the corporate balance sheet is improving, right? So that is the time when value really shines. Because imagine this is a basic behavioral finance question. If you expected a company not to deliver, let's say, expecting a company to deliver a profit of 50 crores, right? Or of 500 crores, right? And it delivers 600 crores, you will not be very surprised. But imagine a company where you were expecting a loss and it actually turns around and delivers profit, right? The reaction in the market will be extreme. And that is what happens when the economy is going from contraction to expansion. The value stocks would have got beaten down during the recession, extremely beaten down, pessimistic view. Your economy is picking up, GDP is growing, right? And the corporate profitability is improving, right? So the companies that are beaten down the maximum will revert back towards the mean. And therefore, the value factor will start to shine really well. As the markets reach a steady state, economy is doing well, the interest rates are under control, right? You will see markets in a trending range, right? Like what we saw from 2022 to less than 2024, markets were trending. They were going up gradually, not as fast as a recovery from a COVID bottom, but they were moving up. In this kind of a market scenario, momentum really does well, because momentum is buying what was doing well for the last 6 to 12 months, adjusted for volatility. And therefore, as the market continues to trend, this will continue to do well. As the markets get extremely richly they get richly valued, and they start probably exceeding behind what the fundamentals approve, that's when the markets will probably start getting range bound, right? That's what we see. During this range bound cycle, what you'll see, the corporate earnings will probably start slowing down. Interest rates will be high and reaching towards their peak. So heavily levered companies, that is the value companies, will probably start to feel the pinch, right? Whereas companies which are operating, let's say, for example, good quality companies, low debt to equity, high ROEs, right? They will be able to borrow at a better rate, or they need lesser borrowings, right? Their earnings will continue to grow because they have a moat, and therefore they are able to increase the prices to reflect the rising, as even if the market is slowing down, right? So these companies will continue to shine. So in this period of time, you'll see quality and low vol starting to do better. And as the market crashes again, the quality companies will do better. The typical defensives that you talk about, right? The pharmaceutical company, the pharma companies, the FMCG companies, they typically are forming a part of the low wall and the quality bucket, right? And they will typically do better in the crash, right? So through the cycles, different part of the cycles of the market and the economy, different styles will do well, different factors will do well, and that's how the things will play out. So you need to be able to understand all of them, or as I said, combine all four and sit peacefully.
And Mr. Haria, who should consider investing in factor-based mutual funds? If you can give some practical tips to the people who want to invest in these.
Sure. So I think, as I mentioned, if you already have equity investing as part of your core, which most Indians today are having, and versus having to go and invest directly yourself through equity stocks in the market without understanding them, if you actually have a advisor trying to create a portfolio for you, I think there are about 4.5 crore individuals who are invested in mutual funds, and probably 2.5, 3 crore who are doing SIPs. This entire audience can look at factor-based investing as part of their portfolio as well. Whether they choose low vol or momentum depends on their style, and which has been beautifully explained by Mr. Prateek as to which style works when. And if you really don't understand, then probably have all four. As you probably invest more, you'll understand more about these and how the styles work. And because they have a universe which is top 200 or top 250 generally, even lesser, you are going into the larger stocks or the larger part of the market, which is more liquid, and the diversification of 30 stocks ensures the risks are also less. So I think it is meant for everyone. It is not necessarily for the most sophisticated investors also. Commonly, it is said that factor-based investing, being a technical way of investing, it is only meant for sophisticated investors. But that's not how I see it. Yes, it requires a certain level of understanding, but it is also those who are starting their investment journey. They can start with these, of course, and learn over the period of time. Because the beauty is, much like how in every other ETF, you can invest very small sums of money as low as maybe 100 rupees, 150 rupees to buy one unit of these particular indices and create a portfolio over time. So you don't need to necessarily have a lot of money to start participating in a low vol or an alpha low vol or a momentum. Just one unit of each you take, you start building it and see how it works. The more you read, the more you understand, of course, you can then upsize your investments. But it is meant for all kinds of investors, preferably those who already have an active mutual fund portfolio. To supplement your active mutual fund portfolio, you can have these. Someone starting their journey and wants to focus only on passives, they can also start with, let's say, a low vol, which is obviously low on the risk and reward curve. It's meant for conservative investors, and then graduate towards probably momentum. And if you're doing an SIP, then like Mr. Pratik mentioned, have an SIP in all four over a period of time. You'll get the benefit of all four through market cycles, capturing higher units at when they're consolidating and then getting the benefit when they go up. And I think eventually you will make the full potential use of how a particular factor will work over longer periods of time. The key is it is equity, it is meant for the long term, and it is systematic, transparent, and meant to provide you with an opportunity to diversify your risk and capture the market growth which is there in the long run. And if you start doing it earlier, the better. So the basic tenets of equity investing remain when you're doing factor-based investing, and it is meant for all investors of all types, all categories, irrespective of how much wealth you actually have. Just that you need to be there for it for the long term. Thank you.
This adding to your point, a lot of times when we think of factors, we kind of assume it's something new. But as I mentioned earlier, right, they have always been a part of your investing journey, right? If you wanted to buy high quality companies, let's say with high ROE or low debt to equity, they're having a strong moat, you were always doing quality investing, right? If you were buying companies that are available for cheap, below their fair price, you were doing value investing. If your portfolio, you've been adding stocks which have been doing well, right, and removing the ones that are not doing well, you were doing momentum investing. And those who are buying for the long-term defensive stocks, looking for companies with high dividend yield, they were buying defensive stocks, which was high, which is basically low volatility investing. So it is nothing new. It's just being made available in a new format or a package, right? Which is easier to implement. You can just go and buy an ETF, which will give you the exposure to the kind of stocks that you're looking to buy anyways. And as he mentioned, as Chintan mentioned, it's transparent. You can see it every day. So I believe factor investing has been used by us for the longest of while without knowing that we were doing factor investing. Now it is being implemented in a rule-based manner, in a systematic manner, and you can access it very easily through ETF index funds or an active fund. So I think it's meant for everyone, and it's nothing which is new.
Yeah, rightly put. It is not new. Instead, it is just presented in a different format to the people. So it is not difficult as such, as people have already been doing it who were investing in stocks, obviously.
Yeah.
Mr. Sinha, my last question now. Are there any emerging trends that could shape the future of factor investing strategy?
See, one thing which I see the biggest advantage is we have typically diversified our portfolios through sectors. We do large, mid, and small, right? I think going forward, we can easily diversify our portfolio using factors. Like, for example, if you calculate the factor tilts for all the active funds, you'll find that some of them will be tilted towards quality, some of them will be tilted towards value, some of them will be buying companies which are doing good quality companies showing momentum. So if you actually analyze the portfolios, you'll find that this is there. So you can actually start diversifying your portfolios using factor tilts, right? Uh, there's a very interesting study that was done in I think 2009 by the Norwegian pension fund when they tried to analyze the returns of their portfolio using factors, and they found out most of the returns that were coming there were coming because of factors that were present. They were not implemented using factors, but when you try to allocate the returns to different reasons why the portfolio has delivered a certain amount of return, they could find, okay, this much return came through quality, this percentage of return was because of the value stocks that we picked. Right. So going forward, you can use factor investing for building clients' portfolio. A. Right. You can actually analyze where the tilts are missing. Is it well diversified? Is it matching your risk profile? So, for example, if I do a factor analysis of a client's mutual fund portfolio, and I say, okay, your portfolio, you are a low risk investor, but your portfolio is heavily tilted towards momentum investing through your different mutual funds, right? I can say, okay, you should add a little bit of low volatility and bring the volatility down and to be in line with your risk profile. Or it could be if your portfolio is not balanced, right? You have a heavy tilt towards two sectors. Let's say, for example, you were heavily tilted towards quality because quality was doing well. And therefore, your portfolio is underperforming today. Add a little bit of value to your portfolio and your portfolio will be a little bit more balanced, right? So you can do portfolio construction using factors. The second thing, what I'll see is proliferate a lot of innovation that will happen in the market, especially in the PMS space. The factors investing you can create customized offering for different investors for a very small amount. Unlike, let's say, a typical actively managed portfolio, a PMS, right, where you need to have a portfolio manager, or a mutual fund needs to have a portfolio manager dedicated to that scheme, and therefore customization is a little difficult. Tomorrow, you can create n number of combinations using factors and do it for each individual investor. So that's another thing which I feel will drive a lot of innovation in terms of products that you'll see in the market. So diversifying using factors, you can have a portfolio, new product offerings coming out, and we are already seeing that in the mutual fund space, right? Both on the active and the passive side. And another would be to identify the risk profile, right? As I mentioned, right? If your portfolio is not aligned with what your risk profile states, right now, or how do we define the risk profile? If your risk profile is, say, moderate, you should have 40% in debt, 60% in equity. But the equity portion, we are not seeing whether that equity portion is high risk or low risk. If the investor has so we could even do, let's say, instead of having a 60% allocation to equity, we can have a 70% allocation to equity, but dial down the risk on the equity portfolio by going for a little bit more low vol kind of strategies, right? Or we can reduce the equity allocation and say, okay, you take higher risk momentum strategies, add more to the debt. So how a client's risk profile is done and how the portfolios are constructed can also see a big change when you start using factors in building the portfolios.
All right, wonderfully explained. So factor investing is a blend of active and passive funds, and investor may explore them for their specific need of diversification, like keeping in mind that it should be for the long term, and depending on their risk profile, they should choose them, and they can also complement the growth and the volatility and the all the four factors together. And they can also explore factor investing funds just to trim down the human bias in their portfolio if they want. Thank you, Mr. Haria and Mr. Sinha, for joining us today and sharing your valuable insights.
Thank you, Versha. Thank you.
Thank you.
With this, Investment Made Easy webinar comes to an end. Viewers, we trust you found the discussion engaging and enjoyed the session. Please don't forget to like, share, and subscribe our channel to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We will be back with our next episode soon. Until then, stay safe, active, and informed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.